What is going on, troop? Welcome back to another video. Today is a super important topic. This is a mistake that I see every level of trader make across the board. This stems from my fucking people. This stems from creators. I'm gonna be honest with you. This is a theory that's been passed along for generations of creators that has been fucking your trading and suffocating your profits, as well as making your trading worse. Okay, let's get one thing clear. Anybody, well, not anybody, but a lot of strategies can be productive and profitable in the market. The goal is to survive the longest. Everybody understands this idea. The goal is to last the longest in the market, right? We all have this inherent idea that every trade has an implied risk and an implied reward. Now, here's the problem. If you've ever asked yourself, or if you've ever said to yourself, oh, I'm willing to risk, before you're entering the trade or you're about to enter the trade, okay, well, I'm targeting a 2RR. Right, let's say this is a trade that we took in the AM session today on Kick. Let's say we run this trade back, right? Let's say we take our entry, okay? Let's say here's our entry. We'll take my typical position size, which is about 10 MNQ. Let's say we take this pointer entry. Go learn about that in my YouTube channel somewhere in there. I'll plug the video over there. Okay, let's say we're taking our entry. This is a piece of my model, right? And then you say, okay, well, I want a 2RR. Okay, so you fixate your take profit on some type of high res low, whatever direction. Some type of higher time frame liquidity, right? Whatever direction that your order's in, okay? Let's just say, okay, I'm targeting the 5-minute buy side off the pre-market move. Like, okay, well, my strategy, I want to target a 2RR. So I'm going to create this random 2RR trade, and there we go. So now I have this perfect little model where no matter what happens here, I'm entering the system where I either make double my money or I lose essentially this remainder, right? That's the idea, okay? Inherently, it's not bad. If you have the right model, you have a good edge, then this is pretty productive. The problem is, and I see this all the time, a lot of really bad traders, and they are good to an extent, but they could be better if they just follow this principle and stop being so static with the way they think about trading, and focus more on liquidity and focus more on being able to invert their bias and being a lot more versatile in the market, which I think is a lot more productive. Now, sure, you have to be more active, but that's kind of how I am as a trader. I'm very active. I make probably 4 or 5 trades a day, depending on the type of implied moves that we're getting on the day, right? Some days I take 10. Some days I take nothing. Like today, I took 1 long, and now it's just been kind of ripping since we basically bottom ticked the day with this move, okay? The problem is they will let their stop loss get completely run. I want to introduce this idea. You are trading not to make money. Obviously, you are trying to make money in the market. You're not trading, though, to make money. You are trading because you have an edge on price. That's the idea. You have an edge. Inherently, that's what you think. If you are trading, you are saying, I have an edge that should be able to predict price within some amount of time boundary, okay? You're not trading to make money. And so when the moment you say, okay, I'm targeting a 2RR, now sure, that's great, you have a 2RR. The moment you fixate that risk and you say, okay, this is my firm stop loss, you are automatically decreasing your win rate and your productivity as well as performance in the market over the long run. Sure, it might work for this trade, but this stop loss means nothing, has no real backing in the market. All this says is that I'm willing to risk this amount of money for this 2RR trade. The way you need to start transitioning your brain is instead of letting your stop loss get completely run, understand that you need to have a dynamic bias. You need to be like this, okay? You need to understand that your conferences, your entry should have a reversible, invertible bias if it fails, right? Every confluence, if you have a good strategy, it should have some type of inversion model that you can take on it in case the bias fails. We do this all the time. Like, this is a very common thing. I have a whole series of videos on my YouTube channel about inverting your bias, inverse pointers, all that good jazz. It's great because my model has such a high RR because I get in and out of trades, basically break even because of the type of confluence I'm entering on. Now, if you're just taking some type of random break in structure and you're just taking these fixed risk sums, sure, you're going to have productive trades, but you're also going to get your stop loss run a lot of the time. And a lot of people won't let it process faster than that. They're going to just say, oh, like, that's just a part of the game. 65% win rate, that's just a part of the game. It's not. It's not. When you have an edge, you say, I have an edge on reading price. Okay, it's not, I have an edge. I have sometimes this edge that works in these some odd cases. No. Study the case in which you lose. And I promise you there was a way to invert your bias somehow, some way. Okay. When you fixate your risk, you aren't trading anymore. That's where you allow yourself to take unnecessary losses. This is all unnecessary. My confluence, my entry model, my full strategy has a way to get out of this trade almost instantaneously for maybe even break-even profit, right? Based on the type of confluence I'm entering on, which you can go learn about on my channel. But in this case, you need to be super open about where price can go. You need to have a dynamic set of conditions that allows you to analyze every area that price could reverse at and say, okay, I will take it to this level, and then I'll take it to this level, and I'll take it to this level, and take it to this level. Obviously, on paper, if you had the hindsight of knowing that price would stop here, you wouldn't want to take this trade. Okay, you wouldn't want to take this trade, obviously, right? It's probably not in your best interest. If you knew for a fact, to a T, that price would only go to this wick right here, you probably wouldn't want to take that trade. Unfortunately, you don't have that ability. So you can't create determinations about risk to reward before you're in a trade. Obviously, if you have an inherent confluence with an extended stop loss and it's incredibly long, like of course, probably don't want to take that either. But for the most part, you should probably take as long as your model allows for it, you should probably take every single trade that you physically can, find a way to reduce and determine when that bias is going to inverse over anything. The moment you start using this, the 12-point stop loss, the 5-point stop loss, the 20-point stop loss, I'm going to risk 1%, I'm going to risk this percent, that's where you're getting fucked up. If you've ever had a trade that you've lost and then it went in your favor, it's because you had either a bad entry, meaning a bad strategy, or a properly set stop loss. It's probably what it was. You were either too early, you were too late, or your stop loss was misappropriately placed. For me, my confluence is a built-in stop loss on itself, as well as a higher time frame stop loss being the high-res liquidity. So at most, my stops would be at this high-res low. This is not about my trading model. There's so many instances where it's like different variations and it's very complicated. But like, what I'm trying to get you to understand is that you cannot approach the market saying, okay, I'm only going to risk this percentage, and the second it gets to 1%, I'm out of the trade. That's not trading, right? You're applying an edge, and then you're reducing that edge that you might even have because you're not letting it breathe. You need to let it breathe. Your risk cannot be associated with mental numbers is 1% roll at 1.5%, the 0.5%. It cannot be that. Obviously, you do not want to take a trade that's going to be outside of some type of inherent risk parameter. Like you don't want to take a trade that is inherently going to doesn't have a lot of upside potential. In this case, you want to have a system where you can dynamically test every single level with a set of confluences that can measure each level. Okay, can price continue? If we're in a long position, can price continue and expand inefficiently towards the upside, proving the market state we're in, right? There's so many models out there that accurately use this type of idea, and there's so many that don't, right? And I'm not trying to diss on any of those creators, and they can take all the profits they want to take. I'm just saying that it's just not the best way to approach trading. It's just not. Sure, you're going to be more disciplined because you're going to have a very static way to get in and out of trades, but you're not, I shouldn't be that quick with it, but you're going to be very robotic when it comes to your trading. You're going to let your stop loss get run, and that's a problem, right? That's a problem. Okay, and if the moment you fixate your risk, you turn your brain off for the ability to learn, right? And so instead of approaching with fixed TPs or fixed stop losses, have inherent price targets, have some type of price target with conditions of what would happen if there was a reversal. What is the only reason you would get out of a long position? Consolidation, or you would enter a short. That's the only reason. There's no other reason. Okay, you shouldn't just trim because you want to trim, and you shouldn't just move your stop loss just because you want to risk a certain amount. Fixed take profits and fixed stop losses are going to be the death of your trading. Let that shit breathe. Biggest piece of advice I can ever give you. Let that shit breathe. We actually got out right in there. And then if you notice, right after this, price consolidated with a slight draw to the upside. I call this trading for a draw. This is something I don't like to trade. I like to trade these implied moves, these massive implied moves. And the moment I get any sign that the market state is fading, then I'm not interested in taking the trade. Obviously, and I said this on the stream, and I say this every single day, there's going to be a tilt in the market no matter what. If that tilt is slow, the time RR on those trades is probably not going to be in your best interest. You want to find trades that have a very volatile tilt. I mean, you can get in, your edge can get in and out very, very effectively, very rapidly. You're not in, these are ugly trades. Would you rather be right or paid, essentially, is what I'm trying to ask, right? Because this is a fucking disaster on your mental. Avoid all this shit. When most of the profit from this entire trade came from the original implied move. And obviously, there is still stuff going on in here. There's still little micro implied moves happening. But is it worth it from a time RR perspective? I would argue no. This is what I call trading for a draw. In my strategy, which again, there's a lot of details out there, and there's no comprehensive 1, 2, 3, 4, 5, 6, 7, 8. There's not. But with my strategy, personally, I will either trade to a draw or from a draw, not for a draw. I'm not trying to trade for these little micro movements. These I kind of call this induction, where we're around equilibrium. In this case, consolidating around PDH, searching for a draw, reacting off draws, and just seeing these really rough moves, okay? Although this is definitely moving towards the draw on liquidity, guys, look at these fucking candles, guys. Massive bullish, massive bearish, massive bullish, massive bearish. Sure, there's a draw, but it's not fucking fun. It's not fun. And there's probably another way to get in on this trade somewhere in here as well. But the point I'm trying to make to you is this, okay? If your trading model, if you are positioning your stop loss for any other reason besides liquidity or your confidence, you are doing it wrong. Obviously, you want to avoid trades that inherently have a bad RR like associated with them. Like if it's clearly there's only one fucking target and you're going to risk a shit ton to get in on that, you're fucked. Okay? You need to, if you're on a prop account, you need to have a good marriage between the implied dynamic risk reward on your trade and your position size, right? If your position size is over leveraged and then you also have this issue with stop loss is not associated with liquidity, that's where you're blowing accounts, right? If your stop loss is purely based on a risk parameter, like I only want to risk, this amount, and then you're also over leveraging, big booty fucking Latinos are sitting on your face. I'm just gonna be honest with you. The best type of model is going to be the one that has stop losses associated with liquidity, take profits associated with liquidity, and being able to be dynamic at those ranges, knowing that you can invert your bias and you can very quickly get in and out of trades and reverse your position. Not all strategies are going to be like that, but the best ones, the most versatile ones, the most aggressive ones, the most productive ones are going to be. I don't care if you have a low win rate. Honestly, win rate doesn't really mean all that much. You need to have a good profit factor. You need to have a good average RR. It's that simple, right? Your stop loss, your take profits, your reason for getting in and out of trades should not be based on anything but liquidity. It's that simple. And then at those levels, you need to have the balls to be able to inverse your bias in case you have something like that pop up. So if you're using fixed risk, I recommend either reworking your strategy, or if it's working, then keep using it. It's perfectly fine. I recommend reworking your strategy, figuring out if there's ways where you could prevent those losses from accumulating and letting your stop get fully run. If there's a way to potentially build out a confluence set, a rule base that could invert your bias. Like let's say, we had some bearish activity. Like let's say there was black box this. What I mean by this is assume all the conditions for an opposite trade were to happen right here, right after this candle. Have a way to study this mechanism and say, okay, I can inverse my bias instead of letting my stop get run. It requires studying, right? But get rid of this fixed risk principle. Okay, this is something that's been passed down by traders because for the most part, a good investing rule is you to have a fixed risk because you're not actively trying to be super versatile, super jumpy in the market. But with a model like this, like fuck, dude, you're always on the charts. You should not be risking some amount of parameter. And that's the number one question I get. It's always like, bro, should I risk 1%? Should I risk 0.5%? Should I risk 2%? No. Just build out a model that works to outperform the market. Build a model not based on any risk parameter, but it's purely based on outperforming using liquidity, being dynamic, being very, very flexible. That's going to be the most productive strategy you can use. Hopefully this was helpful. Hopefully you understand it. Let me know if you have any questions. Let me know what you thought. If you want the indicator, link in the bio. Join the Discord. I'll be live every single day, Monday through Friday. Free live trading, free Discord community, free YouTube videos, free education. We in the trenches, we run this bitch. It's that simple. Deuces, boys. Love you guys.